Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The Australian economy grew by just 0.2% in the March quarter. The result was weaker than economists had expected, and it resulted in the rate for the 12 months at the end of March at 1.3%. That was steady from 3 months earlier. Sally Auld is the Chief Economist at National Australia Bank. Sally, welcome back to Fear and Greed.
Thanks very much, Sean.
What did we learn out of yesterday's national accounts?
So I think we learned that, we are going to have to lower our sights on, the potential trajectory for the Australian economy through 2025. We had started to sense that was a likely outcome maybe a month ago when we got the read on where first quarter consumption partial data was headed, and it felt to us like it was tracking weaker than we and the Reserve Bank had expected. And so I guess today's number, which is disappointing in terms of where we had our forecast earlier in the week, does suggest that the economy is struggling to get up some genuine momentum as we start 2025. But I would caveat that by saying that there were, some unusual things going on in the quarter. A lot of that was weather related, but also some funny things in the way that the statistician compiles the national accounts around how we account for electricity subsidies. So a lot of one-offs going on, and maybe these will wash out as we move into the second quarter, but certainly I think it tells us that we are in for another year of sub-trend growth here in Australia, albeit growth that's a bit stronger than it was last year.
Just digging into some of the details, households, what sort of state are they in?
So household consumption went up by 0.4%, and on its own you would argue that that's a relatively respectable outcome. But what actually happened in that quarter was that electricity bill subsidies that were given by the Queensland government basically ran out. And so the way that's accounted for in the GDP figures is it means less government consumption and a bit more household consumption. And so if you abstract for that effect and say, let's not worry about consumption of energy, what did household spending do? It was only up 0.2%. So actually quite a soft outcome in the quarter. And it's interesting, it's a bit of a puzzle because if we look at the fourth quarter of last year, the consumer did quite well. And it felt like, whether it was a tight labour market or energy bill rebates or stage 3 tax cuts accumulating, and even just a narrative that the Reserve Bank was finished hiking interest rates, all those things seem to give the consumer, some confidence to go out there and spend. And we had thought that, most of those factors have sustained into 2025, and we had a rate cut in the first quarter, but it does feel like consumers have gone a little bit back into their shells, maybe a little bit more cautious. And what we're really seeing is a desire to maybe pay down debt, repair the balance sheet, and save a little bit more.
Is there any sense of why that's the case? I mean, it was pre-Liberation Day tariffs, the March quarter. Is there a Trump effect, do you think?
I'm not sure that it's a Trump effect, but we do wonder whether, we did go through a period for a couple of years where real incomes growth in the household sector, was really quite negative. And that was because inflation rose by a lot and people's incomes didn't rise anywhere near as much. And so that was quite a difficult period for many households. And I guess one explanation might be that the scarring from that period, has lasted a lot longer than many of us anticipated. And that's what's encouraging or forcing consumers to want to pay down a bit more debt, to get the balance sheet looking a little bit healthier. And the way they're doing that is, saving those extra dollars as opposed to spending them.
What about business investment? That's sluggish, it seems.
It is a bit sluggish, and that's been, in a way, one of the missing links in terms of the overall growth trajectory here in Australia. And so we have had this narrative, particularly for the last couple of years, that a lot of the growth we've seen has been driven by the public sector, so government investment, government spending. And what we actually saw in the first 3 months of this year is that narrative reversed a little bit. So actually, government spending was a bit softer in the quarter, and private spending, including consumption and also investment, was a little bit stronger. Now, I'm not sure how sustainable that turn is, because we did note that the statistician said government spending was a bit weaker just because some of these big public infrastructure projects are either getting closer to completion or they experience delays. And while we're all sort of desperate to have a little bit of reorientation in the economy away from public sector driven growth towards private sector driven growth, I'm not sure, even though that's what we saw in the first 3 months of 2025, that we're yet on a sustainable trajectory for that story.
How worried should we be about per capita growth going backwards?
Yeah, so per capita growth did go backwards again in the quarter. And so what we're really saying is that the growth in the economy, in terms of the value of goods and services that we produced, was actually outpaced by growth in population. And that's been, I guess, a reasonably familiar dynamic in the national accounts for a couple of years now. And it's not really one that I guess is overly favourable. But as population growth slows over the next year and or two, which is effectively what the government has in its numbers and it's what the Reserve Bank
Yep.
is forecasting, my sense is that that sort of less favourable aspect of the GDP numbers should start to correct itself. And so it is quite possible, I think, that we might be near the end of that narrative of negative per capita GDP growth.
Stay with me, Sally. We'll be back in a minute. My guest this morning is National Australia Bank Chief Economist Sally Auld. Productivity. One thing about the national accounts, we get all sorts of information on all sorts of economic variables. Productivity still a big issue in Australia, Sally.
Yes, that's right. So this has been, I guess, again, a perennial bugbear of the national accounts for the last couple of years, where we just have had very lackluster productivity performance. And unfortunately, for the first 3 months of 2025, that story didn't get any better and productivity was flat in the quarter. So it didn't go down, but then on the other hand, it didn't go up. And when you actually look at a chart of productivity growth, and we tend to measure that as looking at GDP per hours worked across the economy, it's basically been flat for the last couple of quarters. And so it's telling you that, productivity growth is essentially going nowhere. And so I guess in that sense, that's part of the reason why we've got the negative per capita GDP growth, because we're not really generating any growth from using the inputs into production, whether that's capital or labour, more efficiently. So hopefully that might change in coming years.
How much of a problem is the lack of business investment, or is there a lot more to it?
No, I think that is an issue for this economy because, one of the dynamics that people talk about at the moment is this notion of capital shallowing. And so what's really going on in the Australian economy is that the capital stock, so I guess the outstanding stock of plant and equipment and anything else that businesses use as an input into the production process, has basically, when we look at it per worker, gone down. And so for every worker that we add, we're not adding more capital. And it means that, in aggregate, workers are using less capital to do their job. And I guess the sense is, all else equal, that's not a great story for productivity, because when we think about how productivity often works in practice, it's like you take an individual and you give them, a good set of tools, whether that's a computer or something else, and they can become far more productive. And so this notion of capital shallowing, I think, is symptomatic of softness in business investment, but it also, I think, is one of the reasons why, we're really failing to lift productivity growth.
Okay, now, the Reserve Bank recently cut interest rates 25 basis points. You were one of the few economists that suggested ahead of time that they should have cut 50 basis points. Now, in hindsight's 2020, obviously they didn't, but it's amazing how many economists said, wow, they were a lot closer to 50 basis points than we realised. So congratulations on that. Where do we go with rates, though, for the rest of this year?
So I think the one-line summary would be that rates are going lower. And the real reason for that is, as we talked about at the outset, it does look like 2025 will be another year where the economy grows below trend. And so, what that typically means is that we will see a bit of an upward drift in the unemployment rate from the low fours to around the mid fours. And in that context, the Reserve Bank would be very mindful of not wanting to run what they would call restrictive monetary policy. So they don't want interest rates at a level where they're exerting a headwind on the overall economy. And so I guess the real rationale for lower rates in coming months is just this idea that they need to get, sooner rather than later, monetary policy back to a stance that is, I guess, not a headwind, but not necessarily a stimulant to the overall economy. And we think that's probably a cash rate in the low threes, so somewhere between 3.25. And so for that reason, we have a forecast that they'll cut at their next meeting in July, follow up with another one in August, and then after a brief pause, deliver a final cut for the year in November. So that'll give, another 75 basis points of rate cuts, and I think should see monetary policy far more appropriate given underlying fundamentals.
And so early threes is neutral monetary policy there. How relevant is the Michelle Bullock, the Governor of the Reserve Bank's comments after that last rate cut about growth? There seemed to be less emphasis on inflation. That's all we heard about. Suddenly, that last meeting, that last press conference, she starts talking about growth a lot more. How important is that?
Yeah, it's really important. And that, I think, they did signal that May meeting would be a real opportunity for them to have a bit of a rethink about the outlook and about where policy is and where it should go. And so one of the big shifts they did make at that meeting was effectively saying that they're now far more comfortable, far more confident that inflation is in the middle of that 2 to 3% target band. And that's a huge shift in thinking from them, because they have spent the last couple of years, really worrying that inflation was too high and worrying that they might not have done enough to get it into that target band. So it was really, I think, quite significant that they are now far more assured about the inflation outlook. And because of that, that gives them the opportunity to bring the other side of the mandate into focus. And that's why, in that last paragraph of the statement they released in May, they said, we still care about inflation sustainably in that 2 to 3% target band, but we're also mindful and paying due attention to our full employment mandate. And that's a far more balanced central bank in terms of its focus than we've seen in the last couple of years.
Sally, thank you for talking to Fear and Greed.
A pleasure. Thanks, Sean.
That was Sally Auld, Chief Economist at National Australia Bank. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, business news you can use. I'm Sean Aylmer. Enjoy your day.